Good day, tea with Travis. Afternoon, tea with Travis. Today is August 5th, Wednesday, and boy, mortgage bonds have not been very favorable today, or actually the last 3 days. Last week was great. We had a 5-day run up. Every day closed in the red or in the black for us, or positive for mortgage bonds. Mortgage bonds that had improved all week, or your mortgage rate, and even a nice run up Friday where they gave us an alert to float, which typically means you're going to be safe going into Monday morning. Well, Monday morning came around and some other economic reports came out and some global things that happened, and they started their downward trend, which has been ugly. The last 2 days we've had an alert to lock, meaning if you have a loan floating, it would be a time to lock and stop the bleeding. Well, we had it the last couple days, and the reason for that, first it started with on Tuesday, the pending home sales. It's basically all the contracts that were written in the prior month went up 3.6% versus the 0.7 they had anticipated. So that's a big jump for the housing sector, and that's actually the fifth month in a row that they've had a positive gain. And so that's obviously great for us in the housing and industry and looking for homes. So that was one big thing. And then today, the ADP came out with their payroll numbers, or estimated jobs lost last week, and it was 371,000. That sounds like an astronomical number, but compared to December, when we had 693,000 jobs lost in 1 month, that's nearly a half of that number. So we've seen since December, basically every month, less and less, and fewer people are losing their jobs. And so that's good news. So again, economic news, that's positive. We want our economy to turn around, and our income and things to get better, but it's not very good for mortgage bonds or mortgage rates. So mortgage rates don't operate in a vacuum where you can have really low rates and a really great economy. It's usually inverse of each other. Great economy, high rates; bad economy, low rates. And so anytime there's positive economic news, you're going to see that tick up in rates. And Friday is the big day, because Friday is the big jobs number that the Feds actually produce, and it's a more accurate number. And that everybody's keeping their eyes on that one right now. And the problem is that mortgage bonds, because of this last 3-day decline, they've busted through some layers of support that typically will hold up mortgage rates. They'll bounce off those. They busted through the 200-day moving average yesterday, and now today it's gone through another layer of support with the 25-day. And so we're looking at if it busts through the 50-day, which is the final one, then we're going to have a free fall if the jobs report is really good on Friday. If it's not as good as expected and there's more jobs lost than expected in the 400,000 range, then we might see bonds rally and get back up above these layers of ceilings of resistance now. So rates could take a turn for the worse on Friday, and we might be back in the 5.5% range on a 3-year fix, with the APR around 5.7. All the way up from 5% last week, with an APR around 5.23 or something. So it's been all over the place, though. I mean, we had rates, back up at 5.75 a few months ago. So it's kind of a moving target, but it is pretty volatile right now. So I just want to give you that update. Feel free to tune into our webpage at neliton.com. It's neliton.com for more updates and information. Try to keep that added value there for you, and just let us know how we can help. Love to serve. Be blessed.